Welcome to Chapter 5 of Applied Management Accounting. In this chapter, we are going to explore one of the most practical and frequently tested topics in your exam: short-term decision-making using relevant costs. Here is a thought that might surprise you. Your accounting data is lying to you. Well, not exactly lying, but it is certainly misleading when it comes to making short-term business decisions. Think about it. Managers are surrounded by financial information, profit and loss statements, balance sheets, cost reports. But here is the problem. When you need to make a quick decision, like whether to accept a special order or outsource production, most of that data is just noise. Using all that information actually leads to bad choices. So what is the solution? Focus only on what changes. Ignore everything that stays the same, regardless of your decision. This principle is called relevant costing, and it is the key to unlocking clarity in decision-making. By the end of this chapter, you will have a complete toolkit to apply it confidently. Let us start with the most important concept you will learn today: the FIC test. This is your master tool for filtering out irrelevant information. First, let me give you the formal definition. Relevant costs and revenues are costs and revenues that change as a direct result of a decision being taken. They represent the financial impact of choosing one option over another. Now, imagine all your costs and revenues being poured into a funnel. On one side, you have things like sunk costs, past expenses, and committed costs. On the other side, you have depreciation, allocated overheads, and non-cash items. None of these should make it through the filter. What does make it through? Only incremental costs, future revenue, and opportunity costs. These are the relevant items. So, how do you know if something passes through the filter? Apply the FIC test, that is, F for future, I for incremental, and C for cash flow. Let me spell that out. FIC. F stands for future. The cost must be incurred in the future. Past costs are unchangeable and therefore irrelevant. I stands for incremental. The cost must be additional, arising specifically because of this particular decision. C stands for cash flow. The cost must involve actual cash being spent or received. Accounting entries like depreciation do not count. Here is the key takeaway. A cost must pass all three tests to be relevant. If it fails even one test, you ignore it completely. Exam tip. In your exam, systematically apply the FIC test to every cost in the question. Write FIC in the margin and check each cost against all three criteria. This will prevent you from including irrelevant costs in your calculations. Just as important as knowing what to include is knowing what to exclude. These costs frequently appear in exam questions specifically to test your discipline. Let me introduce you to the SCND shield. That is SCND. S stands for sunk costs. These are past costs, already incurred and unrecoverable. Think of research costs already spent on a project. No matter what you decide now, that money is gone. You cannot get it back, so it should not influence your decision. C stands for committed costs. These are future costs you are already legally obligated to pay. A common example is rent, under a fixed lease agreement. Whether you take on a new project or not, you still have to pay that rent. N stands for non-cash flow costs. These are accounting entries that do not involve real money. The amortization of an asset is a perfect example. It is just a bookkeeping entry. D stands for depreciation. This deserves special attention because it appears so often. Depreciation is the classic non-cash item. Exam tip. When you see depreciation or net book value, which is sometimes abbreviated as NBV, in a question, your first thought should be, "This is not a relevant cash flow." Examiners love to include these figures to see if you will fall into the trap. Remember, if you spot any of these 4 types of costs, shield yourself from including them in your analysis. Now, let us move on to our first practical tool, the material cost calculator. What is the true cost of using materials for a project? The answer is, it depends on the situation. This flowchart will guide you through the decision process. Start by asking, are the materials already in inventory? If the answer is no, the materials are not in stock, then the relevant cost is simply the current purchase price. You will need to go out and buy them, so that is what it costs. If the answer is yes, the materials are already in inventory, then you need to ask a second question. Will they be replaced? If they will be replaced because you use this material regularly in production, then the relevant cost is the replacement cost. Why? Because using these materials means you will need to buy more to replenish your stock. If the materials will not be replaced, you have one more question to consider. Will they be used for something else? If yes, they would be used for another purpose. Then the relevant cost is the opportunity cost. This is the value you would get from that alternative use. If no, they would just sit in the warehouse or be thrown away. Then the relevant cost is the net realizable value. This is what you could sell them for, their scrap or sale value. Now here is the absolutely critical point. The original purchase price of materials already in stock is a sunk cost. Never use it as the relevant cost. That money has already been spent. It cannot influence your decision about what to do now. Exam tip. Always look for clues in the question about whether materials are regularly used, whether they have alternative uses, or what their current market value is. These clues tell you which branch of the flowchart to follow. Our second tool focuses on labor costs. How do we value labor? The key question is whether there is spare capacity. Start by asking, is there spare labor capacity? In other words, are your workers currently idle or underutilized? If yes, there is spare capacity, then the relevant cost is nil. Why 0? Because the workers are being paid anyway. Using them on this project does not create any additional cost. If no, there is no spare capacity, then you need to determine how the labor will be obtained. One option is to hire new workers. In this case, the relevant cost is the cost to hire, which includes wages plus any on-costs, like national insurance and pension contributions. The other option is to transfer workers from other work. This is where it gets interesting. The relevant cost is not just the direct labor cost. You also need to add the contribution foregone. Let me explain contribution foregone. When you pull workers from other profitable jobs, you lose the contribution they would have generated. This loss is a very real opportunity cost. Here is the formula. Relevant labor cost equals direct labor cost plus contribution foregone. And how do you calculate contribution? Contribution per unit equals selling price minus all variable costs per unit. Exam tip. Watch for questions that mention workers being transferred from other production. This is a signal that you need to calculate the contribution foregone and add it to the labor cost. Now we come to one of the most common exam traps, fixed costs. Most fixed costs are non-relevant. They do not change with one short-term decision. However, and this is important, a fixed cost is relevant if the total cash spent on that cost increases because of the decision. For example, renting an extra machine specifically for a new project. That rental cost is a relevant, incremental fixed cost. Here is what you should not do. Do not use the fixed overhead absorption rate. Why not? Because this is an accounting tool for inventory valuation. not a representation of cash flow. It arbitrarily spreads a sunk or committed cost across units. Here is what you should do. Ask yourself, will the company's total fixed cost bill actually increase? This focuses on the incremental cash flow, which is what matters for decision-making. For short-term decisions, always use a marginal costing approach. Focus on contribution and incremental costs. Fixed costs generally stay fixed, regardless of the decision. Exam tip. When you see fixed overhead per unit in a question, do not automatically include it. Ask yourself whether the total fixed costs will actually change. If not, exclude it from your analysis. Let us apply our knowledge to the first major decision type: make or buy decisions. Should we produce a component in-house or outsource it to an external supplier? Think of this like a set of calipers, measuring and comparing two options. On one side, you have the relevant cost of making. On the other side, you have the relevant cost of buying. The decision rule is simple. Choose the option with the lower relevant cost. The process has two steps. Step 1. Calculate the relevant costs to make. Step 2. Calculate the relevant costs to buy. Then compare. What costs do you include when calculating the cost to make? You include direct materials, direct labor, variable overheads, and any directly attributable fixed costs that would be saved if you stopped making the product. What costs do you include when calculating the cost to buy? You include the supplier's purchase price, plus any additional costs, such as delivery charges or inspection costs. Notice that I said directly attributable fixed costs. This is crucial. Only include fixed costs that would actually be saved if you outsourced. General factory rent that you would pay regardless does not count. Exam tip. Always read the question carefully to identify which fixed costs are avoidable. The question will usually tell you something like, if production stops, a certain amount of fixed costs would be saved. Only include that specific amount. The lowest cost is not always the best decision. A full analysis must consider the non-financial risks and opportunities. Let me walk you through 6 important qualitative factors. First, supplier reliability. Can they deliver on time? Will quality be consistent? Are their prices stable? A cheap supplier who delivers late can cost you customers. Second, specialist skills. Does the supplier have expertise you lack? Could outsourcing actually lead to a better product than you could make yourself? Third, confidentiality. Is your proprietary information at risk if you share specifications? Does the supplier also work for your competitors? Fourth, social impact. Will outsourcing lead to redundancies? What is the impact on employee morale? Redundancy costs themselves can be significant. Fifth, customer reaction. Do your customers value a product that is made in-house? Could outsourcing affect your brand perception? Sixth, alternative use of capacity. If you buy instead of make, what profitable activities could you do with the freed up space and labor? Exam tip. Many exam questions ask you to discuss qualitative factors alongside your numerical analysis. Prepare to discuss at least 3 or 4 of these factors, explaining how they might influence the final decision. Our next tool is the discontinuation scalpel. A product line or department is reporting a loss. Should we shut it down? This requires surgical precision in your analysis. Here is the golden rule. Never trust the accounting profit or loss figure alone. The real question is, does the segment generate a positive contribution that helps cover the company's unavoidable fixed costs? Let me give you the discontinuation test. Impact of closure equals loss contribution minus fixed costs saved. If the result is negative, meaning the lost contribution is greater than the costs you would save, then closing the segment will reduce overall company profit. Keep it open. If the result is positive, meaning you save more than you lose, then closing will improve profit. Discontinue the segment. Look at the decision flowchart. First ask, does the segment make a positive contribution? If no, if the contribution is negative, then discontinue. There is no point keeping something that does not even cover its variable costs. If yes, the contribution is positive, then ask, is the contribution greater than the avoidable fixed costs? If yes, keep the segment because it is contributing to overall company profits. If no, then discontinue. Here is a crucial warning. Apparent losses are often caused by the allocation of shared corporate fixed costs, like head office rent, that will not disappear if the segment closes. Those costs will just be reallocated to other departments. Exam tip: always distinguish between directly attributable fixed costs and allocated shared costs. Only the directly attributable costs can be saved through closure. Our final decision tool is the further processing gauge. We can sell a product now or process it further for a higher price. Which path is more profitable? The decision rule is straightforward. Process further only if additional revenue is greater than additional processing costs. Here is the 3-step process. Step 1. Identify the split-off point. This is where the products separate from a common process. Step 2. Calculate the incremental revenue, which is the revenue after further processing minus the revenue at split-off. Step 3. Calculate the incremental cost, which is just the further processing costs. Then ask, is the incremental revenue greater than the incremental cost? If yes, process further because you will earn additional profit. If no, sell at the split-off point because there is no benefit to processing. Now here is where many students go wrong. The sunk cost trap with joint costs. Joint costs are costs incurred on multiple products before they can be separated at the split-off point. By the time you make the further processing decision, these joint costs are sunk and therefore irrelevant. Ignore them completely. Think of a butcher. The cost of the cow is a joint cost. It is irrelevant when deciding whether to sell ground beef or use it to make more expensive sausages. You only compare the cost of the sausage machine and spices to the extra revenue from the sausages. Exam tip: when you see joint costs mentioned in a further processing question, immediately write irrelevant, sunk next to them. This prevents you from accidentally including them in your analysis. Let us put our tools to work with 2 case studies. First, a make or buy decision for Phoenix Electronics. Phoenix produces 8,000 units of a component. The in-house costs per unit are direct materials £12, direct labour £8, variable overhead £3, and allocated fixed costs £7. An external supplier offers to supply the component for £26 per unit. If Phoenix stops making the component, £20,000 of fixed costs would be saved. Let us calculate the relevant cost to make. We add up the variable costs, 12 plus 8 plus 3, which gives us £23 per unit. Multiply by 8,000 units, and we get £184,000. Now add the avoidable fixed costs of £20,000. The total relevant cost to make is £204,000. Notice what we did not include. We did not include all the allocated fixed costs. The question tells us £7 per unit, which would be £56,000 in total. But only 20,000 of that would actually be saved. The rest is not relevant. Now, the relevant cost to buy. £26 multiplied by 8,000 units equals £208,000. The decision, making, costs £204,000. Buying costs £208,000. Making is cheaper by £4,000. Continue to make in-house. Now let us look at a discontinuation decision for Greenwood Retail, specifically their Department C. Department C shows an accounting loss of £4,000. But wait, the contribution is £14,000, which is sales of £40,000 minus variable costs of £26,000. The allocated fixed costs are £18,000, but only £6,000 are avoidable. What is the impact of closing? Lost contribution is £14,000. Fixed costs saved is £6,000. The net impact on company profit is negative £8,000. The decision, closing Department C, would make the company £8,000 worse off. Do not close, despite the apparent accounting loss. Let us tackle two more complex scenarios. First, a material-relevant cost calculation for Henderson Manufacturing. Henderson needs 2,000 kilograms of material Z. They have 1,500 kilograms in stock, purchased at the original cost of £5 per kilogram. But remember, that is a sunk cost. The stock is regularly used and will be replaced. The current purchase and replacement price is £6.50 per kilogram. How do we calculate the relevant cost? For the 1,500 kilograms from stock, use the replacement cost, because it will be replaced. 1,500 multiplied by £6.50 equals £9,750. For the additional 500 kilograms that must be purchased new, use the current purchase price. 500 multiplied by £6.50 equals £3,250. The total relevant cost is £13,000. Notice we used replacement cost throughout because the material is regularly used. Now, a further processing decision for Riverside Dairy. They produce 3 products from a joint process. Joint costs are £50,000, but we ignore these completely because they are sunk. For cream, extra revenue is £10,000, which is £22,000 minus £12,000. Extra cost is £8,000. Benefit is £2,000. Decision, process further. For butter, extra revenue is £2,000, which is £20,000 minus £18,000. Extra cost is £6,000. This is a loss of £4,000. Decision, sell now at split off. For cheese, extra revenue is £13,000, which is £28,000 minus £15,000. Extra cost is £10,000. Benefit is £3,000. Decision, process further. The £50,000 joint cost is completely ignored in this decision. It is sunk. Now it is your turn to apply the relevant costing principles. Let me give you 2 questions to test your understanding. Question 1 is multiple choice. Equipment with a net book value of £15,000 could be sold now for £8,000 or used on a 2-year project, after which it would have no value. What is the relevant cost of using the equipment? Your options are A. £15,000, B. £8,000, C. £7,000, D. £0. Take a moment to think about this. Which cost passes the FIC test? Is net book value a cash flow? Question 2 is a calculation. Thomson Limited produces a component with these costs per unit. Direct materials £15, direct labour £10, variable overhead £5, and fixed overhead £12. An external supplier offers to supply for £35 per unit. Annual production is 5,000 units. If production stops, £15,000 of fixed costs would be saved. Should Thomson make or buy? Pause the video now if you want to work through this yourself. Let us work through the solutions together. For question 1, the answer is B, £8,000. Here is the logic. Net book value of £15,000 is a non-cash accounting entry. It fails the C test for cash flow and is therefore non-relevant. The true cost of using the equipment is the opportunity cost, which is the cash you give up by not selling it. By using it, you forego the £8,000 you could have received from the sale. For question 2, the answer is make. Let me show you the calculation. The relevant cost to make includes the variable costs plus avoidable fixed costs. Variable costs are 15 plus 10 plus 5, which equals £30 per unit. Multiply by 5,000 units to get £150,000. Add the avoidable fixed costs of £15,000. Total cost to make, £165,000. The cost to buy is simply £35 multiplied by 5,000 units, which equals £175,000. Making is £10,000 cheaper than buying. The key learning here is that the allocated fixed cost of £12 per unit is irrelevant, except for the specific £15,000 that is avoidable. The remaining fixed costs of £45,000 would continue regardless. Exam tip: always show your workings clearly, even if the question does not explicitly ask for them. This way, if you make an arithmetic error, you can still get method marks. Let us wrap up with your complete decision-making dashboard. This is everything you need to remember for the exam. First, the core tests. Use the FIC test for relevant costs. Future, incremental, cash flow. Use the SCND shield for non-relevant costs. Sunk, committed, non-cash, depreciation. Second, the essential formulas. Contribution equals sales minus variable costs. For discontinuation, compare lost contribution versus fixed costs saved. For further processing, compare additional revenue versus additional cost. Third, the quick checks for each decision type. For make or buy, ask: which option has the lower relevant cost? For discontinuation, ask: is contribution greater than avoidable fixed costs? For further processing, ask: is extra revenue greater than extra processing cost? Fourth, the top mistakes to avoid. Do not include depreciation or net book value. Do not use the original cost of stock that will be replaced. Do not include all fixed costs, only the incremental or avoidable ones. Do not close a segment based on accounting loss alone. Check the contribution. Do not include joint costs in a further processing decision. Remember the fundamental principle we started with. In short-term decision-making, focus on what changes. Ignore what stays the same, regardless of the decision. Thank you for watching. Good luck with your studies, and I will see you in the next chapter.